And then talk about lifestyle creep for that doctor, right? So, because there's an expectation to have the big house and have the big car. And what does that do, Jason? Puts them further into debt.
Yep.
At what point do you get out of debt? You created a self directed family bank, is what you did, right? So, it's not just for college, to your point. You're teaching financial IQ with the exact same asset. That's what you've done.
Welcome back. Another episode of WealthWise Banking with Jeremy Lee Huggins, Huggy Bear, as we like to call him, Jason Patrick Sipple. We're excited to share something that is on the mind of every parent in America. With student loans debt at a crazy $1.8 trillion, with 92.2% of that being to the federal government. Yes, you heard that. The federal government's number one asset is student loan debt. If you're looking to send your kids to school, to either even put them in private schools when they're younger, because it's really important that we're helping our kids understand how to think, not what to think. And parents are seeing that more and more. And when it comes to the traditional system, there's limitations. I have personally experienced this, and I will share this. You got to stick around, but I'm going to share my personal experiences. What happens when your kid doesn't go to school? What happens to these 529 plans, these state or federal sponsored plans? What are the limitations? And how could you possibly do it a better way? That's how we're going to jump in today. We're going to go into how you can have an alternate way to finance your kids' future, anything they might want to do, whether it's mission trips, entrepreneurial journeys, or whatever it might be. How can you have one system, one place that you have absolute control and guarantees with? So, Jeremy, super stoked to be here in this episode with you. How are you doing, man?
I'm doing great. And I'm actually really excited about this episode because I did not have to use a 529 plan, but I know what would happen to that 529 plan if I use one, right? So, me going to a military academy, my military service actually paid for my college. And I have a nephew who had a 529 plan that we ended up canceling and replaced it with one of these flexible alternatives. What is this flexible alternative that we're talking about today, Jason?
It is, none other than a specially engineered whole life policy that you have control and liquidity with, right? And we did the same thing for my youngest son. So in Florida, they have something that's pretty cool called a Florida prepaid. And we did it for my oldest son, Diego, and we have the same kind of system set up for Connor. And we went through all the numbers the other day, Jeremy, and we'll get into it a little bit, but we went through all the numbers. And we're like, oh, this is still a pretty good thing. So we're going to keep doing this. But at the same time, we went ahead and started Connor's plan a few years ago because our oldest son didn't end up going to college, and it was a nightmare. It was a nightmare trying to undo that, to have it transfer. Like, they wanted Connor to go to college, Jeremy, when he was 14.
Hmm.
Like, that was the solution. I'm like, I don't want a Doogie Howser. Like, if you have that big of a age gap, like that was their plan. Like, oh, well, you could transfer it to your youngest or his sibling as long as they use it within this window of time. So you immediately go to some of the restrictions.
Yeah. So what are some of those restrictions? All right. So 529 plans. 529 plans are section 529 of the IRS tax code. Like that's where the number comes from. Let's talk about what you can use a 529 plan for. How about that? Let's start with what can you use a 529? Just real quickly, traditional universities, vocational and trade schools, community college, some, not all, international institutions, but they have to be eligible for U.S. Department of Education student aid. And what qualifies as a qualified expense? So, in order to have a qualified expense for a 529 plan, not everything fits in that realm. Tuition does, right? Required fees, books, supplies, room and board, computers, internet access, an apprenticeship program, right? But it's an apprenticeship program at a trade school that has to be registered at the US Department of Labor. And this is one thing you kind of hit on at the beginning with all the trillion dollars of debt. Guess how much student loan repayment can be used on a 529 plan? Up to 10,000. So
Hmm.
up to 10,000, but that's a lifetime limit and that's per beneficiary. So with trillions of dollars and the rising cost of education, it doesn't really make a dent, does it, Jason?
No, and to that point, Jeremy, I have taken people that have student loan debts existing and run it through trying to find a way to use infinite banking to pay it off. And we put the debts into some of the different calculators and things that we have access to, it literally shows like if they just pay the interest, they will never pay off their debt. Think about that. Like the government, if you're talking about having other people's money work for you, well, how brilliant is it? Two or three of the things that you just mentioned were tied to federal. You said federal is tied to this federal, right? It has to be approved by the federal. Well, if that's 92.2% of all student loan debt is owned by the federal government, and that is the largest asset of our federal government at over 34%, well, then it doesn't take a genius to know, well, how do they plan on to keep having our money make them money in the future? If we can't even pay off the debt because we're not making a dent in it, because it's so much and it goes out so long. I mean, this is true for doctors I've talked to. I've talked to doctors who've told me, look at my student loan debt's in the hundreds and hundreds and hundreds of thousands. I don't ever expect it to pay it off.
Yeah. And then talk about lifestyle creep for that doctor, right? So, because there's an expectation to have the big house and have the big car. And what does that do, Jason? Puts them further into debt.
Yeah.
At what point do you get out of debt?
At the
To
point,
your,
at the
yeah.
point that you decide enough is enough, this is crazy. It's just crazy. Like, how can I find a better path forward? Like, how can I have something that I am going to control, that I am not limited on how much I can contribute into it in a way, right?
Oh, that's a big one.
That is a big one. And I'm not limited on what I can use it for.
Yeah. So while a 529 plan can be powerful, I think the key point here is that a 529 plan is also narrow, very narrow in scope. So that's why I like the flexibility of funding college with a potential alternative, right? What we're talking about with Family Bank, it's really just a cash flow system that bridges saving and investing. It's a both and asset. If you, like to your point, if Connor doesn't want to go to school, you're not stuck with penalties and limitations. You have the flexibility to pivot. If Connor wants to take a gap year and travel the world after high school and go get that experience, which arguably some would say more beneficial
Hmm.
than a freshman year of college education, he can fund that with his family bank. He can do that with his infinite banking policy. If he wanted to start a business, he could do that without penalty, without taxes. If he wanted to down payment on his house, how about pay for a wedding? He has the flexibility and the autonomy, the control to use that system the way that he sees fit. He's not just stuck with a unilateral 529 plan. And that's why I like it. My nephew, phenomenal athlete, growing up, left-handed pitcher,
Hmm.
great in baseball. He's also playing football. Like the kid just never comes off the field. He's in wrestling. I don't know which sport, if not all sports, he'll likely end up getting some sort of scholarship. But his 529 plan, we determined early on, wasn't suitable for him anymore. So we cashed it out. We used that as a lump sum for his new infinite banking policy to give him optionality and opportunity, right? If he wants to use it for college, he can absolutely use it for college, but he doesn't have to. He's not narrow in scope. Again, 529s are powerful, but they're narrow in scope.
There, and at least like if you're hearing this and you have a 520, and that's great. At least you have a plan, right, Jeremy? Like I'm not here telling you that infinite banking is for everything and for everybody. Like I hope you don't hear that from this message, but I'm telling you from my experience as a father, like with Diego, my oldest, he didn't go to college, and that was the right fit for him. He tried on many different things, and it took him a lot of trying different things on and failing at it, quite frankly, until he found something that he really was passionate about. And so if we had the optionality, we could have used a policy versus having to cash his out, having to take the penalty, right? We ended up putting it in our family banking system so we can support his journey at this point, right? So we're supporting what he's doing going forward, but we had to make those decisions after not really understanding fully what we could and we couldn't do with a 529 if your kid decides not to go to college. And by the way, if they do go to college, like I talked to a dad, this struck me, Jeremy. This guy, makes a couple $100,000 a year. And he's like, oh, my son was so smart. Like he got his AA before he was even out of high school. And that saved us like $48,000. And so I'm really only paying for 2 of his years at Texas A&M. And, that's going to cost, I think he told me, he's in state too. I think he told me it was like 48 grand for the 2 years for, board, room, board, and tuition, and he haven't had a partial scholarship. He's like, and I think he's going to go to his doctor. And the dad goes like this, Jeremy, for parents, if this is what your plan is, he goes, I hope he finds a good paying job. I hope he finds a job that he's going to be able to pay back that college debt. Like he's already worried about his son's college debt in the future. Is
Hmm.
that how, I mean, if you're a parent and you're nodding in agreement and you resonate with that, that's not a plan, folks. That's not a plan to keep giving the government more and more of our money as tuition keeps going up and up and up. And like my wife said, why is it going up? Why is it so expensive? Like the job market isn't rising the same way the government or the tuition is rising.
No, the rising cost of college is insane. I looked at it when, the number one thing that determines whether or not a person at this day and age, the number one thing that will limit a person and going to becoming one of the 1% is actually student loans,
Hmm.
believe it or not. And it's not just higher education, it's actually the undergraduate student loans, it's the bachelor degrees. Because to your point, if you just pay the interest alone, it will follow you for the rest of your life. If you have student loans out there already, I'd be interested. How old are you? And when do you plan to pay them off? Like, do you ever have a plan to pay them off? Because now start adding children to the mix, Jason.
Hmm.
Start adding other obligations, the house, the car, lifestyle creep. When you start having a family, the student loans that you had 5, 10, 20 years ago, a lot of folks will only ever pay the minimal amount. So they'll never actually get out of the debt, get out of the student loans. And so that's a massive problem. To have debt follow you your entire life, that's not right, man. That's just not right.
No, no, that's not. It hurts, right? It hurts to think about, and especially the super educated, right? That have many masters, and if they're not paid for by a scholarship or something else, they're because of their curiosity, the love of learning, the whatever they're doing, all of a sudden, like you said, they've got financial handcuffs. They are tethered to the government, to this loan for the rest of their life, and it's going to affect all of their lifestyle. It's going to affect what they want to do. It's going to affect what they want to leave. And like with Connor, right, to bring it back to real situations, when we were told that you had to either use it within this period of time or just take it and pay the penalty. We did that, took the penalty on Diego's. We're still using Connor's Florida prepaid because in Florida, he can go to a state university for 4 years. It doesn't have the room and board, but the tuition is paid for. And it's going to cost us about $30,000. But if he doesn't go, guess what? I'm going to pay the penalty on that money and take it out and then put it into one of my liquidity funds, put it into one of
Mhm.
my family banking systems. But because I don't know what he's doing, I've made an and both strategy. We have a policy with him. And by the time he's 18, we'll have $81,000 of cash value
Mm.
that we can use for anything, whether it is the trip abroad, a mission trip, whether it is him starting his own business. Like I think that's pretty likely the way that, he's already hustling and buying computers for his editing business right now through our family bank or his family bank. But just think like you start teaching your kids how to be a creator as well, how to use the system by putting it in place. And we didn't even think about touching on this, Jeremy, but you can start using it during the build up to the event that you're building for. And you can teach your kid how to pay that back. Like Connor's going to take a $800 loan to buy his computer and buy a headset for his editing business. And then we've already set up how much of what he's earning per week goes back to paying the loan back to make that whole again. So when we get to 18, all the money's still there.
Yeah, you created a self-directed family bank, is what you did, right? So it's not just for college. To your point, you're teaching financial IQ with the exact same asset. That's what you've done. Then an opportunity to teach
And
them
that sounds smart.
how to bank.
I got to pause there before you, will you say that again? Because that sounds really smart. It sounds way smarter than anything I even thought about. And I'm not even being facetious, folks. Like I literally thought, hey, this is a kid. This is the way I can start talking to my son about money. I can start showing him how it works. And like, we won't let him take that loan until he gets paid for his editing business from the entrepreneur that's hired him. It's not us, by the way, which is pretty cool. Like my
Yeah,
11-year-old with a $5,000 plan on making money this year. So,
we'll put this in place too, right? We're talking about college. What about after college? How does that same asset now get repurposed for the next phase of life and the next phase of life? All the way up until it's going to follow because the product we use is whole life. It's going to follow him for his whole life. So look at the cash value now in his passive income years when he puts in $1 and it turns into $10. and
Oh, it's crazy.
it's supplementing his retirement tax free. Like think of those multiples over time. When you go to page, I think it's 73 of the book, Becoming Your Own Banker by Nelson Nash, he illustrates that $2,000 a year. So this is the illustration for folks who don't have the book. $2,000 a year for the first 22 years. That's $44,000 total net cash injection. There's 101 cash value inside of the policy. So it's more than doubled. Never contributed to the design ever again. And then in his passive income years, this child was pulling out 225,000 a year tax free.
Mm.
And when that person graduated, guess what their estate got? Their beneficiary, their trust, nearly $6.4 million. Keep that in mind. $2,000 a year for 22 years with a cash value of 100K, never contributed to it ever again, going into passive income, 225,000, supplementing retirement, and leaving behind their beneficiary 6.4 million. I know you're looking at my looking it up, Jason. I am right. I have referenced that illustration all the time. And we build those policies all the time for children because that's the power of banking. That's the power of compounding interest started early and allowing time to just do its magic. That's it.
I was actually looking up, like, I will know, Nelson Nash's book. I mean, you got the page rate and everything, my brother. So there's no doubt, and that's long-term thinking. Like Nelson, as soon as there was what a change, Jeremy's favorite word, as soon as there was an event in life, like when he met his wife's boyfriend, I don't even know if they were engaged yet. He's like, "Hey, if you marry my daughter, the first thing we got to get a life insurance policy on you." As soon as they have a kid, as soon as that kid has a social security card, they're getting a life insurance policy. Every time there's a change in your family, you're adding this this wealth warehouse on. So I was looking at Connors. Like we didn't start Connors when he was 15 days old. We didn't start it until 3 years ago. Okay. He's 11 now. So you can do the math. But like when he gets to 80 years old, Jeremy, like it gets crazy. Like I put in $426,000 into this policy. Okay. Over those 31 years, it has over $748,000 of cash value, and the death benefit is well over $1 million. Right. So that is a huge multiplier on the money. He has all his liquidity. Every dollar he's putting in at that point, he's getting more than $2 back.
Well, I want to put this out there for the naysayers because they'll look at that and they'll call it a return on premium, right? That'll be the first thing. I'm going to take the 700 divided by this. Keep in mind the entire process. If he wanted to use it for investing, it's a both and strategy. So
Ooh.
not only is he going to get that growth from the policy, he can also get it from the investment in the exact same way that Jeremy uses his policies to invest in real estate. I'm getting the growth inside of the policy. I'm getting the legacy value, death benefit, the legacy value of the policy, tax free, and I'm getting the growth inside of the investment. So think about multiple returns on the same dollar. That's truly what the power of this policy does.
And by the way, that was my bad. That was a policy on me I was just talking about because I was thinking that didn't make sense, the multiples. I found Connors. Here's Connors. So if you heard that and you thought, Jason, that's not too sexy, how's this? $408,000 in cumulative premium over 71 years. Okay. So he's 80 years old at this point. He's got $2.4 million in cash value. $2.4 million in cash value and over $3.2 million in death benefit.
And my point still stands. That entire 2 million could have been multiplied throughout the entire system, turning it into 4, 5, 6 million if he wants,
Yes.
depending on what assets he's investing in.
Yes, 100%. Now he has full liquidity and control on that. This thing has bought his first computer, his first car. This is our plan, right? Whatever he does once he's done with high school. And we're already talking about like setting him up for those things. We're putting him into rowing. It's about the community, the people you're around, how you're thinking. One of our guests we had recently, just a amazing entrepreneur and father and man of faith, Jonathan Goodwin. If you haven't heard that episode, go listen to it. But he talks about how his dad, him coming out of Detroit, being, not a privileged kid, but his dad did everything to put him in a school where he was surrounded by people that were from successful families, families with means. And his dad said, son, I'm putting you here so you learn how to think. And guess what? Jonathan is one of 400 and some veterinarian cardiologists, and the man makes way more money than any other veterinarian cardiologist that I've ever met and most doctors. And it's because he understands how to think, how to add value, how to solve problems, because of where his dad set him up. So imagine if his dad knew about this to pay for that high school where he went before he went to college, before he went to Cornell, you know. So that gives you an idea that you can use this for whatever you want to help your kids grow and become the person that they're meant to be,
Yeah,
that
it's a
creator.
teaching tool,
To,
right? It really is a teaching tool to the point that we've made earlier, to the point you're making now. This is the same asset that, like to your point, paid for laptop. It can pay for his college. It can pay for his travel experiences. It can pay for his first investment. It just continues to multiply over and over and over again. And it's a both and strategy. And when people hear, it's like, oh my goodness, it's whole life. Look, it's not life insurance from Jake over at State Farm. This is properly engineered by Jason, by Jeremy. We are one of, what was it, 200 and change, right? There's only like 200 of us between Canada and the United States.
yeah, I think there's three. I think there's three 10-ish of us, and that it's still a super super small group where it's not everyone is taking the time to become a certified infinite banking practitioner. And I'm telling you, from one dad to another, I could not be more excited about the journey and what we're teaching Connor, what Diego is now hearing and being taught. Like he can't wait to have his system set up. We're working towards that as a family. And we talk about what it looks like to have the systems and processes later. But all we're talking about today is an alternative or an and strategy to the 529. With the 529, you have restrictions, you have limitations. They have made it more flexible than it was in the past because they realized it was too restrictive. Now they're not, now it's not just for college, a lot of them. Now you can use it for, elementary school, you can use it for high school, you can use it for different private schools, but it's still limited. It's still restricted in a lot of ways, and it's still used for one thing, for that education. They'll let you take it out and maybe put it back in the market, Jeremy, but it's not for anything that you need it for. That's the point
Yeah.
we're trying to make.
Yeah, I think it's more important to really understand that you're building an education plan. You're building an education plan that works if college happens,
Yes.
as well as if it doesn't. So if college happens, this is great. If college doesn't happen, it's still great. It's just as good. There are no penalties, there are no fees that are associated with it. Why? Because you have full control. You control the banking function in your life. And so long as you have the control, you get to determine how to use the funds, right? This policy, it helps keep your dollars flexible. It helps keep them productive, and it keeps everything within your family system. And that's what I love about it. And because that predating the IRS tax code, all these other features and benefits, we're just telling you another strategy. That's all this really is. It's infinite banking, which means there's an infinite number of strategies. Today's episode is about one strategy. It's about taking the handcuffs off your kids' education.
Unless you like Uncle Sam and you want to keep having 34+% of our debt as citizens owed to him because your kid went to college so they can get a below average paying job potentially, or just hope that they're going to figure something out. If you're listening to this, I went to school for medical illustration. That's kind of weird. It's kind of niche. And, I did it for a while because I was like, well, I have an $80,000 education back in the 90s. I should probably use it. It took me like 10 years to pay off that debt. And guess what? When I got out of school, my first job offer, Jeremy, I got offered a job doing medical illustration with an $80,000 degree, making less than I did as a lifeguard in high school. Yes, that's right. You are just hoping, and hope is not a plan. You want to take control. You want to set your kid up with a financial acumen and a system that supports whoever they become as creators in this world.
I love that. I love it. So let's start wrapping it up, man. We gave parents out there plenty to think about. People who plan to have kids, this is another strategy for you as well on how to take back that banking function in your life. So we'll tell you, you're already in banking.
You're just not the banker yet. Book that call with us to learn how you can apply this alternate to a 529 plan, a plan you control, liquidity, control, and guarantees. We'll talk to all of you soon. We're blessed to have you here. As always, see you in the next episode.
Take care.
Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, Financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.